Across Australia's capital cities, the gap between buying a house and renting has become impossible to ignore. Take Sydney. With a 20% deposit, a mortgage on the median-priced house would cost roughly $8,700 a month. The citywide median house rent? About $3,700. That is an initial gap of more than $5,000 every month before transfer duty, council rates, or the day the hot water system dies and you are the one writing the check. But that gap does not automatically mean renting wins, because there is one assumption most rent versus buy comparisons get wrong, and once you correct it, the entire answer can flip. For many Australians, buying is not just a financial decision. It is what your parents did. It is what responsible adults are supposedly meant to do. But they bought into a very different housing market. So let's walk through 3 numbers that could determine whether renting or buying leaves you better off. No property predictions, no, it always goes up. Just the maths, and the assumptions hiding underneath it. Number 1 is the monthly gap. These examples use Domain's March 2026 median house prices and June 2026 median house rents. The mortgage calculations assume a 20% deposit, a 30-year principal and interest loan, and a 6.15% rate, the Reserve Bank's May 2026 average for new owner-occupier principal and interest loans. This is not a perfect same property comparison. A city's median rental house may differ from its median house being purchased, but it gives us a consistent affordability snapshot. Sydney's median house price was about $1.79 million. Estimated mortgage, $8,732 a month. Median house rent, about $3,683. Gap, just over $5,000. In Melbourne, the estimated mortgage is $5,277, compared with median house rent of $2,600. Gap, roughly $2,677. In Brisbane, the estimated mortgage is $5,908, compared with rent of about $3,033. Gap, roughly $2,875. Now, homeowners will correctly say mortgage repayments build equity. They do. But in the Sydney example, around $7,346 of the first payment is interest. Only about $1,386 reduces the loan. The buyer is building equity, but much more slowly at the beginning than the repayment suggests. And the mortgage is only the first layer. Number 2 is everything the mortgage calculator leaves out. On Sydney's median-priced house, general New South Wales transfer duty under the 2026 to 27 rates would be approximately $79,800. That money does not reduce the loan or build equity. It is an upfront transaction cost. Eligible first home buyers may pay less. In New South Wales, eligible buyers can receive a full exemption at $800,000 or less, with concessions available below $1 million. Then come conveyancing, inspections, loan fees, and moving costs. After settlement, there are council and water rates, building insurance, possible strata fees, and repairs. Hot water system dies? The owner pays. Roof leaks? The owner pays. Maintenance varies enormously by property, but it still belongs in the calculation. And with a deposit below 20%, some borrowers may also pay lenders' mortgage insurance. Despite the name, it protects the lender, not the borrower. Eligible buyers using the Australian government's 5% deposit scheme may be able to avoid it. So the fair comparison is not mortgage versus rent, it is total ownership cost versus rent. But even that does not settle the argument, because number 3 is where the answer can flip. Number 3 is the assumption most comparisons get wrong. They assume the renter invests every dollar of the gap, every month, for 30 years, without touching it. If the difference gets spent on holidays, cars, or lifestyle creep, the strategy is not rent and invest, it is simply renting. Now let's see what happens when the renter genuinely invests it. Imagine an $800,000 home. A 20% deposit is $160,000. For a standard New South Wales purchase, transfer duty is about $30,200, although an eligible first home buyer at that price may receive a full exemption. For this illustration, assume the renter starts by investing $190,000 instead. The estimated mortgage is approximately $3,900 a month. Assume a comparable home rents for $2,600. Initial difference, $1,300 a month. If the renter invests the full $190,000 plus $1,300 every month for 30 years, the result depends on the return. At 5%, the portfolio could grow to approximately $1.9 million. At 7%, approximately $3.1 million. At 9%, approximately $5.2 million. These are illustrations before tax and fees, not forecasts or guaranteed returns. So the renter who actually invests could end up with somewhere between $1.9 and $5.2 million under those assumptions. Now let's look at the other side. The same house, the same 30 years. An $800,000 home growing at 3% a year could be worth approximately $1.9 million. At 5%, approximately $3.5 million. At 7%, approximately $6.1 million. Change one assumption and you change the winner. And neither comparison is complete. Rent may rise, mortgage rates may change. Owners pay rates, insurance, and maintenance. But the mortgage eventually ends, while rent usually continues. Tax also matters. ETF distributions and capital gains may be taxable, while an eligible Australian main residence is generally exempt from capital gains tax. But the deepest assumption is behaviour. The renter only builds that multi-million-dollar portfolio if the deposit and monthly gap are actually invested. Not occasionally, not only when markets feel safe, consistently for decades. So, does renting or buying win? Buying may come out ahead when you stay for a long time, can comfortably carry the full cost, and the property performs strongly. It also gives you stability, control over the home, and protection from a landlord deciding to sell. Renting and investing may come out ahead when the buying premium is wide, flexibility matters, and the difference is genuinely invested. But remember the assumption from the beginning. If the renter does not invest the difference, the equation can flip back towards the buyer, even when renting initially looks thousands of dollars cheaper. To compare the two properly, ask 4 questions. Are you comparing genuinely similar properties? Have you included transfer duty, rates, insurance, strata, and maintenance? How long are you realistically going to stay? And most importantly, will you genuinely invest the difference? There is no universal right answer, but you will not find your answer by copying what your parents did in a completely different housing market. The Australian dream says owning is always the destination. The maths says the destination depends on the assumptions and the discipline behind them. The spreadsheet does not care whether you rent or buy. It only cares whether you counted everything. And your future self will care deeply about what you did with the difference. This is general information only and does not consider your objectives, financial situation, or needs. Property prices, interest rates, rents, and investment returns can all change. Consider speaking with a qualified professional before making a major financial decision.